You've built up a solid $10,000 trading account. Then you hit a rough patch and take a 25% loss. Your intuition immediately kicks in. You're down 25%, so you assume a 25% gain will get you right back to even. In reality, that symmetrical recovery is a mathematical myth. Our brains naturally map numbers in straight, linear lines. The market, however, operates on an exponential scale, where every dollar lost makes the next dollar harder to earn. Operating under this false sense of symmetry is how intermediate accounts slowly bleed out. To survive, we have to look directly at the actual math of a drawdown. This chart tracks a severe 50% drawdown. Watch the baseline drop, taking that initial $10,000 balance down to exactly $5,000. To climb back to your original $10,000, you have to generate $5,000 in profit. But because your starting capital base is now cut in half, the remaining block has to double its height. You need a 100% gain to reach zero. This relationship is governed by a strict equation. You take your loss percentage, divide it by 1 minus that same loss percentage, and multiply by 100. This curve shows what happens when we map that formula to deeper losses. As the drawdown increases on the horizontal axis, the required recovery spikes violently upwards. A 75% loss demands a monumental 300% return. Once a drawdown passes a certain threshold, the recovery requirements become so steep that the math effectively locks the account into an inescapable hole. Even if you manage to claw your way out, you pay a steep compounding tax. Every month spent battling back to break even is a month you aren't growing your capital. That lost time robs your account of its future wealth creation potential. The pressure of that mathematical reality triggers a psychological minefield. Valid trade setups start to look terrifying, and frustration quickly clouds your analytical process. Eventually, logic breaks down. You start taking large, volatile swings, desperately trying to win it all back in a single stroke. When lost compounding time and emotional panic collide, it creates a feedback loop, leaving little room for error before an account is fully depleted. Because you cannot reliably outtrade the exponential math of a deep drawdown, professional strategy shifts away from offensive recovery. The only viable path is absolute preemptive defense. The foundation of that defense is the 1 to 2% rule. This circle represents your total equity, and the rule is that only a tiny isolated wedge, a maximum of 2%, is ever exposed to the market on a single trade. Applying this requires precise position sizing. Instead of guessing volume, you calculate your exact lot size based purely on your entry point and the distance to your stop loss. That stop loss is your predefined, emotionless exit. It acts as an automatic circuit breaker, closing the position the moment your thesis is proven wrong, long before the damage compounds. By treating your risk parameters as mathematical functions, you remove human emotion from the equation and build a structural shield around your capital. This defensive philosophy scales up to your entire macro strategy. You stop hunting for high volatility trades that carry outsized risk and start prioritizing modest, repeatable gains. You also protect the broader portfolio by diversifying your trades. Opening positions across uncorrelated assets ensures that a sudden market swing doesn't drag your entire account into a simultaneous drawdown. Take a moment to run the math on your own worst-case scenario. If your absolute limit for a disaster is a 30% loss, you are committing yourself to a 43% climb just to survive. Enforcing these limits requires consistent, low-latency execution. The FXNX platform is designed with the charting and risk management tools needed to lock in precise position sizing and protect your remaining margin. Understanding the asymmetrical math of drawdowns dictates how you operate. By using precise tools to prioritize capital preservation, you remove the guesswork and align your trading with the mathematical realities required for long